Thank you for joining us on Godrej Properties Q4 FY 2018 results conference call. We have with us Mr. Pirojsha Godrej, Executive Chairman, Mr. Mohit Malhotra, Managing Director and CEO, and Mr. Rajendra Khitawat, CFO of the company. We will begin the call with opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we begin this call, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the conference call invite email to you earlier. I would now like to invite Mr. Pirojsha Godrej to make his opening remarks.
Good afternoon, everyone. Thanks for joining us for Godrej Properties fourth quarter financial year 2018 conference call. I'll begin by discussing the highlights of the quarter and the financial year, and we then look forward to taking your questions and suggestions. We've just completed the best ever year in GPL's history in terms of the value and volume of real estate we've been able to sell. For the first time in its history, GPL has delivered sales of more than rupees 1,000 crore in each of the 4 quarters of the financial year. Also for the first time, we have emerged as amongst the top 3 developers by value of real estate sold in each of our 4 focus markets of Mumbai, NCR, Bangalore and Pune. In the financial year, we were the largest developer in NCR and Pune, based on the numbers we've seen, although these are still to be totally finalized for our peers. The second largest developer in Mumbai and the third largest developer in Bangalore by value of real estate sold. I'm happy to note that we have sold more than 1.25 million square feet with a booking value of over rupees 800 crore in each of our focus markets. This has largely been possible by combining our traditional strength in new launches with a strong improvement in sales from existing inventory, which stood at 2,780 crore in FY18, representing a growth of 164%. The total value of bookings in FY18 stood at INR 5,083 crore, which represents a 152% year-on-year increase. As a result, we are likely to emerge as the largest publicly listed developer in India by sales value in FY18. We are especially pleased with this sales performance given the sales of the industry as a whole have declined during the financial year. Our sales for the fourth quarter stood at rupees 1,054 crore, which represents a year-on-year growth of 210%. We had a strong launch at Gurgaon with sales of 250 apartments worth approximately 245 crore, and were able to combine this with robust sales from existing inventory across our project portfolio. Coming to our financial performance, our total income for the fourth quarter was significantly bolstered by revenue recognition at Godrej Origins, the third phase of our flagship development, The Trees, and also by a deal with Godrej Fund Management, who has purchased a 50% stake in Godrej 2, our second commercial building at The Trees. As a result, our revenue in the fourth quarter increased by 79% and stood at rupees 849 crore. Our adjusted EBITDA increased by 85% to rupees 241 crore, and net profit increased by 126% to rupees 142 crore. For the full financial year, our total income increased by 38% to rupees 2,397 crore. Adjusted EBITDA increased by 28% to rupees 660 crore, and net profit increased by 14% to rupees 235 crore.
I'm sorry to interrupt you, sir. This is the operator here. May I request you to come a little closer to the phone because your voice is muffled a bit.
Apologies for that.
Thank you very much.
We'll try again. This has also been the best ever year for GPL in terms of collections, with our collections having increased by 54% to rupees 3,891 crore. As a result, we have generated rupees 1,868 crore of net operating cash flow in the financial year, which has allowed us to reduce our debt by rupees 653 crore while continuing to rapidly grow our company's development portfolio. Financial year 18 has also been the best ever year for business development in terms of the number of new projects added. GPL added 12 new projects with saleable area of over 23 million square feet this year. More than 80% of the area added is in partnership with other real estate developers, and all the projects added are in the 4 largest real estate markets in India. In the fourth quarter, we added 4 new projects, including a project in Gurgaon with a saleable area of 0.75 million square feet. The Indian real estate sector has undergone a lot of disruption in the past couple of years, starting with demonetization in 2016 and then continued with the Real Estate Regulatory Act and GST being introduced in financial year 18. These measures are all helping drive consolidation in the sector. A weak property market and increasing consumer preference for stronger developers has created an unprecedented business development opportunities for developers with strong customer franchises and development capabilities. We believe GPL is well placed to capitalize on these opportunities in the business development space. We also believe the Indian real estate sector is at the cusp of a demand revival that will be aided by the fact that affordability is the best it has been in 15 years, and also by new regulations that have improved governance in the sector and will lead to improved consumer confidence. Our launch pipeline looks robust, with new launches planned in the current financial year in all our focus markets of Mumbai, Gurgaon, Bangalore, and Pune, as well as in Ahmedabad and Kolkata. We strongly believe our focus on building presence in high-return markets with a deep focus on execution across our project portfolio puts us in a strong position to benefit from a recovery in the sector and improve market share in the years ahead. I'd like to also take this opportunity to update you on an important recent development. Today, our Board of Directors has approved a resolution to issue 1.27 million shares at a price of rupees 783.5 rupees per share, aggregating to 1,000 crore on a preferential basis subject to shareholder approval. We intend to use the entirety of these funds as growth capital to further accelerate our scale within the country's 4 largest real estate markets. On that note, I conclude my remarks and I would like to thank you again for joining us on this call. We'd now be happy to discuss any questions, comments, or suggestions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking your question. Anyone who wishes to ask a question, please press star and 1 at this time. The first question is from the line of Abhishek Anand from JM Financial. Please go ahead.
Yeah, good evening everyone and congratulations on a very good quarter. So my first query will be, of course, on the growth capital we have raised. So if I understand it correctly, does this growth capital means that we will be more looking for outright land or profit share as against a DM model? Is my understanding correct? Because DM, of course, doesn't require much capital.
Thanks, Abhishek. I think it's not that we won't look at DM projects. We'll continue to do those. But yes, I think it's fair to say that what we're looking to do is accelerate the scale of expansion of the company, both in terms of number of new micro markets we're able to enter, as well as economic interest in these new projects we participate in. I don't think we're looking to shift the model to an outright purchase model by any means. I think we are very happy with the partnership structures we are currently using. But we are interested in looking at bigger, higher value projects and at looking at higher stakes for GPL within those projects.
Okay, and any timelines you see for deployment of this 1,000? So I understand that this won't be used to repay debt in any way. So I think it's a pure business development capital you have raised. So any timelines we should estimate for deployment of the same?
Abhishek, this is obviously dependent on timelines for various deals to actually conclude and us to be able to put it to work. But I think certainly the team's main goal this year is to deploy capital in business development as rapidly as we can. We certainly hope to deploy this full amount within the financial year. But the exact timing will obviously ultimately depend on when deals close and so on.
Great. Secondly, on Godrej 2, if Pirojsha, you can give us some more details, because I think 50% has been sold, but if you could give us some more details of maybe what was the valuation of the transaction and how much was booked during the quarter,
Abhishek, we're not at liberty to give the exact disclosures on the amounts because, there's obviously another party involved in this. But I think what I can say is that from our perspective, we're quite excited about Godrej 2 and the value creation opportunity. At the same time, with the desire to deploy a huge amount of capital in new residential development, we thought a structure where we remained strongly invested in the project, but weren't responsible for putting in the full capital invested needed for a large project like this was the ideal balance. So that's what we've pursued here with this project. I think obviously the other income going up gives a general idea of the kind of valuation, but we're not at liberty to disclose the exact details.
And how much will be the capital now required in the project from our side in Godrej 2?
So the total capital required for Godrej 2 is in the range of around 1,400 to 1,500 crores. So 50% of would be GPS contribution.
Okay.
And of course, it'll be a little bit lower than that. One, we've already gotten some capital. Secondly, we'll get some development management fees, etc. But that's the approximate number.
And finally, one last one, Pirojsha, we understand the cash flow has been pretty good. But if I look at the construction spend year on year, I think it has declined from 1,400 crores to 1,100 odd crores. Despite us adding significant amount of projects, launching significant projects. So, is this a one-off or it's that the run rate we are looking at, 1,100 odd crores annually?
No, I think you'll see it sharply increased, actually, Abhishek. I think the reason, first of all, we just need to check the exact numbers mentioned, but I think one of the reasons is that BKC was completing at the end of the previous financial year, and the finishing costs and other things there were of a relatively high nature, so that slightly skewed those numbers. But I think certainly you should expect to see that number growing quite strongly in line with overall sales growth, etc. in the years ahead.
Perfect. Thank you so much, and I will join back in the queue. Thank you.
Thanks, Abhishek.
Thank you. The next question is from the line of Tanuj Mukhija from Bank of America. Please go ahead.
Thank you for taking my question, and congratulations for once again very strong pre-sales by Godrej Properties. My first question is, now that Godrej Properties has raised 1,000 crores of capital, which will be deployed purely for business development purposes, and you added incredibly 23.5 million square feet in FY18. So what's the target of project additions that you have in mind on an annual basis?
Tanuj, I think it's not something we prefer to give guidance on. And honestly, we're not that focused on that million square feet number. I think it's more on the future profit we've locked in is how we're really focusing on it. So according to the business plans we're making, how much future profit are we locking in? And, obviously if you do a deal, say, in an attractive location in Mumbai, you may not have the same kind of area numbers, but we'll certainly look at the value sharply increasing. What I can say is that we're looking at this in a fairly exponential way. So I think, looking at the capital we actually deployed in business development last year, I think we're looking to do at least 3-4x of that this year. I don't think that necessarily will, again, be reflected in terms of the area that is added to the company's portfolio, but hopefully will be in terms of the future profit locked in.
Great. That's helpful. And just one small question. Godrej Properties added a project in Sector 3, Gurgaon, on a business model of 95% revenue share. That's incredibly high percentage of revenue share, and I think we have moved away from revenue share to profit share. So can you elaborate on the terms and conditions for this project and why the shift?
Hi, Tanuj, this is Mohit here. So this Sector 3 deal is, in all fairness, is actually a purchase deal. We were just structured it with a part revenue share, because of certain, various reasons. But you should look at it almost like frankly, an outright deal. And it was, the scale was very apt for us to take that project on our own balance sheet.
So what is the advance paid for this project? I think it will be a very high proportion for this project.
This is not an advance. This is, you almost treat it like, we have paid, Rajendra can give you the exact number, but we have paid the money as a non-refundable deposit, which is almost like a land payment, and a 5 to 7% of top line goes to the owner eventually.
And I think one of the benefits, it's somewhere in between our typical partnership structure and an outright, because the payment is slightly staggered, and there's a small upside through the stake. So and given the fact that we think this can be turned around very quickly and it's a small size, we do think the returns are akin to a joint venture kind of project.
Great. And lastly, on this quarterly results, can you help us reconciling what is the recurring EBITDA, and are there any one-offs that you booked in the expenses?
Yeah, there are several one-offs, both on the income side with Godrej 2 sale. There's also actually about a little over 150 crore of write-off we've taken during the quarter. Well, we won't share the exact breakdown. I think the majority of that is in our older commercial projects in Kolkata and Chandigarh. And the rationale here was that, we've been making best efforts to sell those projects. I think the pricing, we think, clearly needs a bit of a haircut for us to monetize those as fast as we'd like. So I think the goal we've taken now is to clearly monetize those projects 100% within the current financial year. And to help do that, I think we've looked at what pricing we think would allow us to achieve that 100% sale and taken a write-off accordingly. There are a few other minor items as well.
Okay, great. Thank you for answering my questions. That was very helpful.
Thanks, Tony.
Thank you. The next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much, and congratulations on once again good pre-sales. Just two questions here. Number one, if you can share what is the other income attributable to Godrej 2 in this quarter?
Yeah, no, again, Puneet, as I mentioned earlier, we're not at liberty, given the confidentiality in the agreement, to disclose the exact amount. We'll get a rough sense from the total other income, but we're not able to give the exact number.
Okay. And secondly, if in 4Q you have this advance to JV partners going at almost 146 crores. You've also raised money recently. Should we think that the advance number would also be at a higher run rate from now on, or is it just one-off this quarter?
No, I think it would be a disappointment if it's not at a higher run rate. Again, the whole purpose of this capital is to fund business growth. So you should see that reflecting in higher investments. As I said, we'd like to see this year over last year that number growing by 3 or 4x. So hopefully we can make that happen.
Yeah, because over last 3 quarters you've been adding 3 to 4 projects anyways with 5 to 12 million square feet of area, and you've been paying out almost 30 crores. This was almost 146 crores.
Yeah, I think again, you'll have to look at the share of the project, the structures and so on. But the reason we think that we can increase it is by taking sort of higher value projects that can generate more absolute return in a shorter time frame. And again, not necessarily exactly correlated with the size in terms of million square feet.
Okay. And lastly, we are now, 1 year post-RERA. Are you seeing significant changes even now in terms of, better valuation for these JD projects, or has it remained where it is over last 1 year?
So, Puneet, I think the market obviously is quite tough, and the RERA consolidation story is continuously playing out. So we see a good correction in the valuations when we are talking to the landowners for both partnerships and also on the land per se.
Okay, so it has only improved since then, or because it's improved? Okay, that's all from my side. Thank you so much.
Thank you. The next question is from the line of Manish Gandhi. He's an individual investor. Please go ahead.
Yeah. Hi, Pirojsha, Mohit, Rajendra. Good evening, and congratulations on many firsts. So my first question is, now the new DP is out. So do we have a clarity on Godrej 3, the commercial?
Manish, actually the final new DP is not actually out. So while the government has obviously made some announcements about it last week, We're still awaiting the final document. If there is no changes from the last one, Godrej 3 should be a possibility. However, we don't actually have the document yet, so it's not possible yet to confirm that.
Okay, so we should be knowing within a month or two. Okay.
Yes, as soon as the government.
I was just wondering, in new launches this year, why that Vikhroli 2 JVs are not shown? So, because now the dumping rule has been relaxed, so...
Yeah, I think that the dumping round, obviously we lost time. The DP, we've not been able to make adequate progress. So once I think, as you said, the dumping round hopefully, is resolved, at least there's a temporary respite. And the development plan, we'll have to see exactly when it comes finally. And the approval process in Bombay, now that you have to also get RERA approval, you have to get full environmental clearance and things. We think it's quite likely that these launches actually get pushed into FY20. Obviously, we'll leave no stone unturned to try and pull them into this year, but from a guidance perspective, we thought it was appropriate to keep it out of this financial year.
And the last one, Pirojsha, so how do you look Mumbai market? Because last 2 years there has been dumping issue and many deals were stuck because of that. And if I see, as you said, that you might have many opportunities larger opportunities to deploy capital in Mumbai. And even if I see one of the competitor, Oberoi Realty, is changing its stance, talking about increasing volume and market share. So I just curious to see what is happening in Mumbai.
Yeah, I think obviously Mumbai is the most vibrant, dynamic, probably competitive market in the country. I think what's happening in Mumbai and around the country is that the sector is consolidating. So the largest 5 or 10 developers in each of these cities are significantly gaining market share. I think the data now clearly shows that if you compare top few developers' market share changes over the last 4 or 5 years. I think Mumbai is very interestingly poised because with some of this DP kind of lack of clarity moves into something that, we can move past, and if this dumping ground issue is sorted out, I think there are a lot of positive factors going for Mumbai, including that prices now have been relatively stagnant for a few years, so affordability, which has historically been a big issue in the city, is at least better than it has been in the past. I think if you look at the kind of infrastructure developments being planned in Mumbai, whether the metro, the new airport, the road network, I think you're going to see a dramatic benefit to the real estate sector from all of these. So we remain, extremely bullish on Mumbai. But really our focus in all 4 of these top markets will be to very quickly enter as many of the new micro markets as we can, and certainly Mumbai is a big priority amongst those as well.
Yeah, okay, that's all from my side, and I'm very happy that we are raising all the 1,000 crore for the growth capital. So it's a great opportunity, and I think I'm very happy about it. Yeah, thank you.
Many thanks, Manish. Thank you.
Thank you. The next question is from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks for the opportunity. So, Pirojsha, just a clarification at the start of the call to a question. You said that the growth capital will be used to enter into new markets, or is it, new micro markets within the 4 key focus areas that we have? Could you just clarify that?
Yeah, absolutely, Mohit. Totally new micro markets. We're definitely not looking at entering any new cities. So almost all of that investment you should expect to see going into Mumbai, NCR, Bangalore, and Pune. But within each of those 4 major markets, there are a large number of micro markets in which we don't have a presence. So I think the whole focus will be on entering as many non-competing micro markets as we can.
Sure, this is helpful. Secondly, this is and I see this is the 3rd probably consecutive year that, we have not paid dividends. We have not decided to pay dividends. Just wanted to get a sense of, what is the benchmark and, when do we decide, or what's the strategy? If you could just refresh that for us, that will be helpful.
Sure, Mohit. I think the company we think is poised at a stage where there is an opportunity for rapid growth. There is an opportunity that's not going to be available forever for very significant deployment into business development. And we think any capital that the company can source will generate a much higher return for shareholders being deployed in this manner than being paid out as dividend. Also, there are, as you know, some tax inefficiencies with dividend. I think the question on, when the company will start paying a dividend is one that really will depend on how this balance between opportunity and capital availability looks. I wouldn't expect, honestly, for the next 2 or 3 years that we would be changing this policy. Obviously, the board will review this every year and take a call. But certainly it seems to us that we are in a stage of the industry and stage as a company that there is a lot of opportunity to deploy capital, and that the best result for shareholders will be to redeploy any capital we are earning into new projects. Clearly, at some stage, if the opportunities seem less exciting, or at a stage where the company is throwing up enough cash that it can both capture those opportunities to the full and also pay a dividend, this will obviously change. And over the long term, clearly we hope to be a strongly cash generative company that does pay meaningful dividends. But certainly it seems very clear to us that in the near term, this is the correct strategy to maximize shareholder return.
Sure. Thank you and all the best.
Thanks.
Thank you. The next question is from the line of Saurav Kumar from JP Morgan. Please go ahead.
Hi Mohit, hi Pirojsha, hi Rajendra. So 3 questions. Firstly, on this, your cash flow statement, so this land and approval related outflow which is there, is that for ongoing projects or is this for new projects?
It's for both.
50 crores.
So it's for both. Like, certain approval related things, it is for our existing projects like trees, commercial projects. And there are certain new projects which are, which we have tied up. So we have to pay certain premiums, other statutory payments, So it's for both existing as well as new.
Okay, I'm actually trying to figure out what is the net operating cash flow from your existing projects. So I have this arithmetical sum of all your projects of 4,000 crores collection and roughly 2,200 crores of construction. And how much of the 650 crores you think would have been for the existing months? Or?
So, Saurabh, we can take this offline. Right now, it will be little, taking longer time to explain you the full things on the call. So why don't we, meet someday and, just, take your queries over there.
Okay. And secondly, just on this underwriting for these new projects, the way you guys are thinking about it. So how much, what is like Godrej Properties economic interest of this 5,000 crores or you sell? How should we think about it in terms of PBT or however you want to define it?
Can you just repeat that question, sir, for the new project?
So basically, I'm just trying to figure out how much of this, the 5,000 crores you're selling, how much is our economic interest in the profits you will make? So the 5,000 crores generates an X profit, and what percentage of that basically belongs to Godrej Properties?
Going forward, you're saying?
Yeah. So what should be your economic interest of this 5,000 crores?
Basically, see, the strategy is obviously to, maximize our share of profit per square feet of sale, to summarize it in a simplistic manner. Now, exact numbers are based on the situation, the site, the micro-market dynamic. But from whatever we are currently earning, it would be, significantly higher because the capital deployment will be much higher for the same set of transactions.
Okay, so your capital deployment will be better on this. Okay, good. And just one last question. So basically on this 5,000 crores, the way I understood it, for my understanding, the land is already paid out, so that is not, that is not part of the free cash which Godrej gets, right? So it is netted off from that. So it's only the incremental approvals against land. So sales minus incremental approvals and the construction. And that balance profit is what is shared with the
land is paid out. So whatever the balance land payment which we have to make on account of, trees project has been paid out to, in the last financial year. So there's no additional land payment on account of trees. And, other than that, like I said, most of it is a joint venture and our advances get linked to certain milestones. So there may be certain milestones, for which we may, some advances will be paid out in the future.
Okay. So basically this 1200, so basically if I look at your cash flow statement, so 4,000 crores of inflow less 2,000 crores of outflow, you get about 1,900 crores of free cash, operating cash flow for the year, which is effectively a 30%, depending on how you treat the 650 crores, but basically you have a 45% odd operating margin of this 5,000 crores, and this belongs to Godrej, right?
So this is for the entire project, So it includes
So basically you're capturing about 45% of the entire project free cash. That's a fair assumption, or?
Sorry, come again, Saurabh?
No, I think this cash flow can be sometimes something like BKC or something with 100% sold by collecting 100% of it to the company. So I don't think you can match those numbers like that.
I think that correlation may not work at the portfolio level.
Okay. I'll take
it offline.
Yeah, we can discuss it offline and we can explain you exactly how it works on a project level.
Okay. All right. Thank you.
Thanks, sir.
Thank you. The next question from the line of Manish Jain from Sage One. Please go ahead.
Yeah, I just want to know, in Mumbai, when can you start doing the BD deals? Given the dumping issue is still there, or if you were in talks with someone, you can start closing the BD deals?
So Manish, first of all, when we are saying Mumbai, we look at Mumbai, even greater Mumbai like Thane and some of the other areas, and we feel those are very interesting micro markets. But specifically coming to Mumbai, we are looking at opportunities where, some of the opportunities where the approvals are at advanced stages and things like that, some of the redevelopment opportunities. And, we are finding interesting opportunities within the Mumbai city as well today. And we are in advanced talks with a couple of people.
And you can go ahead and close these with the issue resolved now?
Yeah. Given there's a window of opportunity right now, I think projects which are at fairly advanced stages of approval are somewhere we can enter and, turn it around within the time frame.
But please also, we would, if any major capital deployment would be affected by this, we would link this to the disbursement of that capital.
Perfect. And two housekeeping questions for Rajendra. First is this Ind AS 115 revenue recognition issue. What's exactly going to be the impact on new projects revenue recognition from 1st April 18?
So Manish, we are studying this impact. So there is a standard which is effective from 1st April. It is dependent on certain conditions. So we are discussing with our auditors. So exact nitty-gritties, nuances we are working out, and we are talking to several other industry players. So it will be premature for me to comment exactly what would be the impact. So as we get more clarity, we would be in a better position to give it impact.
And my last question is on Godrej BKC. We had the money to be received. Have we received the entire money, or still something is to be received?
We received half of the outstanding amount in the fourth quarter, and I think the half is expected this quarter.
Thanks. I'll join back the queue.
Thank you.
Thank you. The next question is from the line of Aditesh Chattopadhyay from ICICI Securities. Please go ahead.
Yes, thanks for giving me the opportunity. The first, just to understand now with Godrej 2, you said it is 1,500 crores of capex gross. And you also are building the 5-star hotel there on the trees. So combine these two projects, what is the total committed capex for the next 3-4 years, which we will have to put from our balance sheet?
Yeah, hotel, again, we've not decided the exact capital structure, etc. So we've just figured out Godrej 2 that we'd like to do it through this route. The hotel is obviously a much, much smaller project than Godrej 2. Godrej 2 is a 1.2 million square foot development. The hotel will be a fraction of that. I don't think any of us have the exact details, but the hotel total investment is, I would imagine, in the range of 400-500 crores. And this our share of future investment will be another 500-600 crores.
Okay. Secondly, just this is again for Rajendra, just again an accounting question now. So if I see your balance sheet on the financial assets, both on the current non-current investments has gone up by quite a bit in both current non-current plus our investment in joint ventures and associates. So is that the cumulative figure which is there in the JVs?
So, because of the Ind AS, it gets classified into, so the equity part gets classified into investment into joint venture, which is non-current asset, and the non-equity part gets classified into financial assets, So, we do investment like Godrej 2, ours is a 50% stake, so half of the equity portion has gone into whatever has been funded through debt, it will come into the investment into, non-current assets. So similarly, we have done certain deals for Pune. So it gets split between the two, depending on the structure of the transaction.
Okay. And so going forward in the next couple of years, do you expect more projects to come in JV to hit the revenue recognition? Because currently, I believe a lot of projects are not getting captured, where we are doing a lot of sales.
Definitely, because these are the existing accounting standard or the guidance note requires certain conditions to be fulfilled before you start recognizing. So, if we continue into the same standard, definitely we'll see a lot more recognition coming into the coming quarter.
But one of the things is, which we have to now understand, as Rajendra says, is new 115 that is it 115 that has come about, suggests that there might be a thing of project completion method accounting, which clearly would then delay some of those recognition. But I think whether that is applicable, which cities it would be applicable, all of that is currently being understood.
Okay. And just last a question on the balance sheet. Now, obviously, with your 1,000 crores you have raised, now our debt equity is pretty comfortable now in terms of absolute ratio. So, going forward now, again, are you looking at debt at an absolute level or again as like 1:1 or 0.5:1? What is the sort of ratio that you would be comfortable with?
Yeah, I think we'll stick with the guidance we've issued on this ever since the IPO, which is that to our teams, the appropriate range is probably about 1:1 to 1.5:1. I think one of the strategic advantages the business has is our ability to access capital at attractive costs. So our average borrowing cost today is only about 7.8%. Tax adjusted, that's sort of a 5% source of capital. Given our outlook for the industry, given our outlook for the total opportunity, we think it would be not sensible of us to not take full advantage of this 5% source of capital, while obviously also maintaining overall prudence and making sure that we don't let that become a drag on business performance, as has often happened in the sector. And we think that the range at which those things are balanced continues to be in that 1:1 to 1.5:1. Anytime we are over that, we will look to steps to generate more cash flow and bring it within. Anytime that we are under that, as we are now likely to be at the end of the current quarter, it's clearly a signal that we are looking to deploy more capital as fast as possible.
Okay, fine. That's it from my side. Thanks.
Thank you.
Thank you. The next question is from the line of Abhinav Sinha from CLSA. Please go ahead.
Hi, thanks for taking my question. On the new capital that you have raised, just wanted to check if the deployment of this is almost sort of set for you in that it will be, let's say, a large portfolio that you acquire or a couple of large projects, or you are still pretty much flexible on this one?
Yeah, no, it's nothing set in stone. We have a large number of kind of opportunities that are under the evaluation and negotiation stage, but it's not that we have identified this for a specific thing and the deployment will happen tomorrow or anything like that.
Okay, and on the Godrej 2 development, so from here on, are we likely to see a lease and hold model for this? Or yeah? Or you will prefer to follow the BKC model where you lease and then sell out to the private equity partner?
I think we'll definitely lease this. I think in all likelihood it will be a lease and hold, but it could be a lease and then once fully leased, sell as a full development. So I think, whether to hold it or not post-leasing is something we'll evaluate, but I don't think we will have strata sales as we did in BKC.
Right. And just on the launch pipeline that you've given for the next year, so can you give an idea of what we can expect in the first half or what is likely to happen near term?
Yeah, I think there's so much uncertainty on these regulatory approvals, etc., that even the full year guidance is tricky to give. But I think, we hope to launch in Mumbai with Project Godrej Alive. There are a couple of other projects we hope to launch this quarter. But I think better not get into too many details on this for now. But, I think we were quite happy last year to start the year off with a very strong momentum. I think our residential sales last year were highest in the first quarter. So we hope to start the year with good momentum again, but frankly it will depend on the final approvals, etc.
Right, and given that we don't have Vikhroli inventory available with us significantly this year, do you think last year is a fair benchmark to compare FY19 sales with?
For Vikhroli?
Vikhroli inventory is much lesser for you to sell.
I don't think we'll be able, unless we get a new launch, we won't be able to do the same value as last year. Last year we sold about 700-800 crores worth of space in Vikhroli.
Right.
I don't even think we have that. I'll have to check this. I don't even think we have that much inventory.
Sorry, so I meant from a company's perspective, will you be able to hit 5,000 again?
Nice roundabout way of asking for guidance, which we tend to try not to give. But look, clearly the goal of the company is not to degrow in any year. So at the same time, it can happen if things don't go according to plan and things get delayed or we're not as successful as we hope to be. But certainly at the start of the year, our aspiration is not to degrow from last year.
Sure. And just one last question on the on the NCR market itself. So we have 3-4 launches planned this year. Is it looking better now? The market itself?
Market is looking very similar to what it was in past. So don't see much change actually, in any direction actually.
Okay. Thanks and best of luck. Yeah.
That as we've seen with our project in Noida, now this most recent project on Sona Road, I think we're very happy with the volumes we're achieving despite the market.
Right. Thanks.
Thank you.
Thank you. The next question is from the line of Samar Sada from Kotak Securities. Please go ahead.
Yeah, hi, good evening. My apologies, I joined the call a bit late, so sorry if I repeat the questions. Pirojsha, firstly, many congratulations on an amazing quarter on sales as well as FY18 as a whole. I just had a couple of questions on the financials and then on the launch pipeline. On the financials one, if you just explain, or Rajendra, if you might explain why the gross margins particularly low this quarter.
So as Pirojsha said, we have taken certain write-offs, one-offs, so into Q4. So because of that, the gross margins are depressed.
What is the quantum of the write-offs?
And again, 150 crore plus.
Okay, and I'm sorry, this will be against?
This is largely somewhere as we had said at the start of last year, the goal was to monetize our commercial portfolio completely in FY18. We see, the progress on BKC last year being very satisfying. And while we're not fully monetized, I think we think most of it is monetized, and clearly the rest will go at current pricing this financial year. However, we also saw that in Chandigarh and Kolkata, the pricing we had, we weren't really able to move much stock and, had very, very low sales in those projects during the year. So we've once again set ourselves the target of fully monetizing those two projects this financial year. And, the question to the team was that whatever we've tried to do so far hasn't adequately worked. So if we take a big haircut on the price, we think that can allow us to do this. So this was largely reflected in writing down the fair value of those two assets.
Okay. And could we assume this Sector 3 addition in Gurgaon is an outright purchase because 95% revenue share seems pretty high?
It's like somewhat it's akin to an outright purchase, and I think that's a fair way to look at it. But I think just a couple of caveats I would add to that is that the returns that we can generate, we think, are quite similar to a JV because some of the payments are staggered, unlike a full outright purchase on day one. And the owner does feel that there is some upside potential from this small revenue share they have, which also helps with valuation. So I think with those two caveats, yes, I think it's more akin to an outright purchase than a typical joint venture.
Okay, and just one query on the launches, like somebody just asked it, but 10 new launches for FY19, and I'm pretty confident that a lot of business development or business plan activity goes into it. Some part of it is dependent upon approvals, and we've seen that in the past that the launches have been delayed. What is the confidence of, and most of these projects are large projects for FY19, what is the confidence that like even 70-80% of these launches will go through in FY19?
Obviously, the confidence is reasonably good, or we wouldn't put it there. But at the same time, if you look at the slide, we put a pretty prominently displayed disclaimer talking about the kind of risk of regulatory approval. So, there's two ways we could do this, which is only put things which we're relatively certain about. But the fact is that any project where we have the approval, we tend to immediately launch. So at the beginning of the year, there's not a high degree of certainty on almost any project. So is it likely that 10-20% of these, for some reason or the other that we can't anticipate right now, slip out of the financial year? If I had to bet on it, I'd probably say yes, that is likely. At the same time, we think currently, based on the information we have, that most of these are very likely to be launched. We also, in most recent years, have been able to add some new projects to this list during the year. So hopefully we can also do that.
Okay, and if I could just squeeze in a last comment, it's mostly on your accounting, of course. Like we'll wait what happens with the 115. But you show most of your income from the joint venture projects as a part of your other income from an accounting standpoint. So it becomes a little difficult to track it. So any thought process to make some changes towards it or make it a little easier for analysts or investors to track it?
No, I think we're happy to discuss this and understand better. But obviously our first priority is on making the system work for ourselves and our JV partners in terms of sort of present value of the cash flows. But certainly happy to help simplify it if there are ways we can do it without affecting that.
Great. And all the best for FY19.
Thanks a lot, Samar.
Thank you. The next question is from the line of Himanshu Zaveri from Dhruv Germs. Please go ahead.
Hi. Yeah, hi everyone. I wanted to ask, though our profit has come good, but is it safe to assume that except trees, we have not been able to scale up the profits as much as we would like to? And then wouldn't it be a good idea to have, 3 or 4 high margin projects like the Oberois of the world, where they buy a couple of big lands and then, sell them at a healthy profit of 40 to 50% net, like they are doing in Borivali and Thane, the Glaxo land which they bought currently?
Yeah, thanks, Himanshu. I think, there's obviously relative advantages and disadvantages to different strategies, but I think it's fair to say that we would like to see the profitability of the overall portfolio move upwards from here, and I think our business development strategy is tailored around that. We don't believe that means that we should shift to an outright purchase model, but certainly the share we are able to get in our profit-sharing partnerships and the locations we select could be geared towards improving profitability, and we certainly will look to do that.
Okay. And as we have raised this new 1,000 crores, so can we now take that next big leap, of launching couple of or 3 new projects per quarter, and then along with that, the other project phases which we can sell with that, so then we can sell, like 2.5 million square feet easily per quarter. So we reach that 10 million square feet easily per year.
Certainly that's what we'd like to do. I think obviously saying it is easier than doing it, but I think the near-term target, I think Mohit set the team, and maybe he can talk about it some more, is that in every one of our focus markets we should have a launch at least every quarter, which would then obviously lead to a number even higher than what you mentioned. I don't know if you want to add anything.
Yeah, Himanshu, that's the overall vision, and that's how we are driving the business. But as Pirojsha said, to build that pipeline and to get those projects and approvals in place, I think it's a matter of time and we will get into that cycle.
Okay. And regarding the Mamurdi project, is it that DM of 11% and plus the profit sharing of 26% both, as I think we've never signed the kind of deal like this before, and what advance have we paid over there?
So Mamurdi is a deal where we have bought the land with a fund, and the fund is paying us 11% DM fee for the development. The project is paying us 11% DM fee, and it's a perfect way of doing an outright purchase, but then structuring it as a profit share arrangement between us and the fund. You're right. It's the first time you got DMP of that magnitude from the fund partner.
So this is the same fund, the Godrej fund which we have, or is there some other fund?
No, it's someone else.
And how about the Godrej fund which we are doing? The money is like exhausted, or still we have like quite a lot of money to be deployed over there?
No, we do have a little bit of additional capital to be deployed, and also certainly we're looking at this both from our fund management business and from GPL as kind of a long-term opportunity and strategy. So as and when this capital gets deployed, the goal will likely be to raise another fund to do this. I think in a future fund, one of the things we'll likely do in line with the overall business development strategy we've mentioned is try to increase our share in the fund economics. So that we're continuing with these JV structures, which we think definitely generate higher returns than outright purchase, but that within those JV structures, we're taking up our share of profit.
Okay, thanks a lot and all the best for the future.
Thank you.
Thank you. We'll take a last question from the line of Ritvik Sheth from Deep Finance. Please go ahead.
Hi, good evening and congrats on a fantastic year gone by. Sir, most of the questions have been answered, just a couple. So what is the value of inventory for Kolkata and Chandigarh after this 150 crore write-off?
So it will be around 275 to 300 or so.
Okay, and area on the books would be the inventory?
So area would be somewhere around 8 to 9 lakhs.
8 to 9 lakhs, both combined?
Yes.
Okay. And so once we get this 1,000 crores capital, promoter holding will go down from current 75% around. So any plans, going forward to bring it back to 75%?
No, nothing at the moment.
Nothing at the moment. Okay, sir. All the best and thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
I hope we've been able to answer all your questions. If you have any further questions or would like any additional information, we'd be happy to be in touch directly. On behalf of all of us, thank you again for taking the time to join us today.